Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Adrian Nicholson. Adrian, how's your week been?
My week's been great, Roshan. Doing well. Happy to be here on this podcast. Looking forward to our topic today.
Yeah, as am I. As am I. Adrian and I just came back from our firm's conference, RTA Wealth Management Conference, and I really enjoyed this one. Adrian, what did you think of it, and did anything stand out?
Yeah, a lot stood out. It was definitely great seeing everybody who we haven't seen for about a year now. All the advisors, our home office, just across the country. So it's just a great way for everybody to come together, just check in, see how everybody's doing, bounce ideas and off each other. So ultimately, I just had a great time. It's always a good time being in Chicago.
Yeah, it was. It was definitely a great time. And what stands out for me is the dinner on the second night. We show up at dinner at actually even before then they had like a happy hour at one venue that started at 5. Then they had dinner that started at 7. And at this happy hour, I start talking to a colleague, Mario, and so it's my Mario and I, and then our colleague Eric, who listeners know as Eric Olson from the Retirement Lifestyle Show, and Adrian. Four of us are talking at happy hour. That extends out to dinner. We're sitting at the table at dinner, and uh, we ended up staying there while the staff was cleaning up around us, and they were closing down the space. Of course, we're talking about investments and different thoughts and processes, different everything from portfolio management to individual stocks to strategies, investment stories, everything. It was a great time. I'd actually say it was the for me. I think it was the best conference I've attended because of that. And there's one thing that I took away that is actionable that I'll use. I always like sharing those things. Actually, the next I couldn't sleep that night because there this what we'll talk about today. Our topic being having a sell discipline for your investments or what you should do. That's what we'll talk about now. I got to my room, couldn't fall asleep because I was just thinking about this. I actually ended up. I never have trouble sleeping, by the way. I ended up waking up at 4:30 and couldn't go back to sleep. So I just took a shower and started working on this right away, all focused on this sell discipline conversation. Or primarily, there were other things we talked about that had me thinking and researching and looking, wanting to look into it, and literally just started working early that morning. Then we had the last half day of the conference, was working on the thing. Actually, was talking to the colleague Mario. Our flight was at the same time. We continued this conversation at lunch and then flew off. So today we'll talk about one aspect of that conversation, which was a sell discipline that can vary for all types of investors. And Adrian, before I jump into it, anything to add or any thoughts on what I've shared so far?
Well, I think we kind of connected on just the value of this conference, where again, you can just meet other people, network, bounce ideas off of each other, and just a great melting pot of just information that you can just use in your own practice and own ideas when it comes to your investment strategy, which just goes a very long way and just a good way to just continue learning and just growing as much as you can.
Yeah, I agree. And there are different people from there are many ways, styles, strategies, and types of investments out there. So people come from all these different approaches. So it's always interesting to hear their thoughts and see if you can take what they've done, learn from them, and possibly use it to enhance what you're doing, which is really where this sell discipline conversation I think is really was very valuable for me. So let's jump right into it. So what a sell discipline is that's a reason you'll sell an investment. So um, if every investment that you have, you've bought it for a reason. And yet, as an investor myself, typically what I'm looking for is to hold something, ideally in a perfect situation, hold it forever, right? But there's a lot of reasons to sell. Some of those are you know, the fundamentals can change on an investment. That what that means is either a company you thought would grow at a certain rate isn't growing as fast, so that's where the fundamentals deteriorate. Or you bought it and it was, if we're using a price to earnings ratio, just because that's very commonly used, you bought it at a price to earnings ratio of 10, it's at a price to ratio earnings ratio of 20, so it's gone up in value. So that's one reason people will sell when it's gone up, right? The issue that I'd like to discuss today is more, well, what do you do if it's gone down? That is a challenge not only for me but for many investors will have that same problem. So Adrian, you were there when we went over all of this. I don't know if anything stood out to you, but let me ask you that question. You've bought something, you've researched this company, you've bought it, and now you wake up and a few weeks, a few months later, and it's down. Uh, what would cause you to sell, or what did you take away from that?
So there would be two things. The first one is thesis, and the second one is discipline.
Okay.
So the thesis is ultimately how you get to purchasing the investment in the first place, what you're looking at, and then why you bought it. That's how
Okay.
I would describe it. And then the discipline part is a set of guardrails for this investment that you're in. So the thesis is a reason for you to buy something or not to buy it. And the guidelines or the guardrails are the disciplines that keep you from making any decisions or emotional decisions or anything that would break the reason why you had that thesis and why you bought or sold the investment. So if
Okay.
the stock went, yeah, go ahead.
Before you go into the discipline, the guardrails, can we just describe uh, a situation where it's due to the thesis?
So let's just say you just have, let's just call it company A. And one thing that you really like about them is their management is starting to go into a certain area or certain market that you think will be very valuable and very profitable for the future. And then the stock is going down, and you figured out that the management had a quarterly call and say, you know what, that market that we were talking about, we were going into, we're going into a completely other one. That to me
Mm-hmm.
is a good reason where, okay, my thesis is broken. Maybe I can look at maybe doing something else.
That's a
So going
great.
back to the two things that I pointed out is, let's just say the position company A went down, but they're still going into that market that I think is very valuable. Then I maintain that position because my thesis hasn't been broken. But again, the discipline is you put on those certain guardrails where you could say, hey, let's just say it drops 10%, then that's where I maybe will reevaluate my thesis or I might sell. And that's the guardrails just to keep you more, I mean, the term I'm using definition, more disciplined. So I know I went over a lot, but do you think I'm kind of getting in the right direction, Roshan?
I think you are. I think that's wonderful. So with the thesis change, I think that was a great example. You bought it because you wanted to invest into the industry or sector or area they're going into. Further down the road, they're no longer going there, so you sell. The discipline one, I like that as well. I think there's a lot more complication there, but one or a lot more to discuss there. That's putting on the guardrails. In your example, you had said if it drops 10%, you either reevaluate the thesis or sell right there. A couple important things to note on here. First, our disclosure. This isn't investment advice. I don't want people to think, oh, they should always, sell at a 10% drop or anything like that, because that's what Adrian's saying. So we're doing this to help you become a better investor. What I do think you could use this for is say, okay, well, what would be your sell discipline if you had one? While I was doing my research on this, there's a study from December 2012. It's called The Effectiveness of Sell Discipline Strategies in Institutional Investing by Ryan Kennedy out of the University of Albany. You can literally Google it and you'll find it. The conclusion of this was a more restricted sell discipline tended to perform best. Um, so it had either better performance, or if it lagged behind, it wasn't significant. However, this is not, the evidence isn't conclusive, and it depends on what performance metric you use. I bring this up and I share both sides of the coin, the outperformance, but it's not conclusive, because I think this is very important for you to develop your own sell discipline based on your comfort level. This is not a you've got to do X because of whatever reason. And I think, Adrian, you said it really well with your guardrails. At a 10% drop, you would reevaluate your thesis or sell. So I'd call that 10% drop a reevaluation phase, not necessarily an auto sell phase. My follow up to you is not that you necessarily have to use it, or if there is one you use, do you have a no matter what, if it drops X, I'm going to sell, or uh, whatever your determination is after 10%. Let's say you put in $100, it's dropped to 90, you reevaluate because that's 10%. Would you then do another reevaluation after another 10% drop? What happens?
Well, I guess the way I would answer that would be just to get to the point where is this something that you can consistently abide by? And I think that's at the heart of it. And we talked about, I think, a couple podcasts ago, this could in a way help you identify what kind of investor you are. Because let's just say you have this thesis, you put up these guardrails, and then the markets take a turn and you find that you can't abide by them or you can't continue on this direction, then that's where you really toss everything out the door and find something that does work for you. Because again, you want to take out any of the, or just pull yourself out of the equation in this way and just keep it more the facts, the numbers, your strategy, and what works for you. And I think that's how I'd really would just respond to that question. If you want to expand
Yeah,
on that more,
I
you can.
no, I love that. I'll tell you, as you're describing it, having studied a lot and feeling that I relate most with the value style of investing. If you bought using the numbers, you bought that stock for 100 because you thought it was a good deal, and it dropped to 90. Isn't it a better deal now? Assuming nothing's changed on the thesis side of things. So it's really tough to then sell at that point, right? And what you've described, if you can't abide by the rule, it's not a rule, right? Then it's not worth it, which is why earlier I'd mentioned you've got to find what works for you. It's got to be something you can follow, or uh, you'll just do it. You'll take away your thoughts and your emotions, and you'll just do what you have to do at that point. You've got to build a rule around that. That's why, once again, it's so important. Once again, while studying this, William O'Neill, whose book is called How to Make Money in Stocks. I believe he's the founder of Investors Business Daily. He has a rule where, and he gives a range of 7 to 10% decline. You sell automatically and don't give it a thought. And if you really want to uh, be strict with this rule, you can put a stop loss in so it will automatically sell for you and you don't have to process the order, thus potentially taking emotion out of it. Once again, I'm not giving you advice, I'm giving you ideas right now. A little bit further on O'Neill's, some of the rationale behind it is primarily you want to avoid getting caught in a big decline. And just as an example, numerically, if a stop drops, it takes more to catch up than it takes to decline. What I mean by that is a stock that loses 10% needs 11.1% to recover. So if you drop from 100 to 90, well, that 90, if it goes up 10%, you're at 99. You're not back up to 100. If it drops 20%, you need a 25% gain. So the same example, you bought it for 100, it's down to 80. A 20% gain would be 96. So 25% is the gain that you need. One other tip he had mentioned, which I think is really valuable, it doesn't necessarily help with the sell discipline at the time because it's not rules based, but you ask yourself, would I buy this stock now? And if the answer is no, you sell it. You can't quantify it like you can quantify a 10% decline, but that's where I think your sell discipline isn't necessarily just one rule. So, Adrian, with your example on guardrails and reevaluating at that time, I would encourage you to, if you have a list of what you do to reevaluate, I would add this question to the list. So if it dropped 10%, then you ask yourself, would I buy this stock now? And if the answer is no, I think you've got to sell. But once again, this is not necessarily, this is a part of a sell discipline because you're not automatically selling at that point. And
Mm.
automatic sales might not be necessary either. It might just be reevaluation for you, coming up with your own rules.
Yeah, and what I like about these tips and ideas that you're giving our viewers and listeners today is how valuable they can be, especially in times with market volatility, with big up and down swings. I mean, everybody would like just a smooth ride in the market, but as we know, markets are unpredictable and sometimes they have these big moves. So having them in place earlier and just really just structuring it in the best way that fits you can help you when times of market volatility pick up or big swings happen in the market. So this is definitely something like financial planning, getting started earlier is the most important thing. There's no too late to start because again, this can help you when the market volatility picks up so you can have better decision makings, more experience, and just really take the emotion out of any other decisions just so you can put the odds in your favor.
Yes. And yeah, I'll add a couple more ideas on onto what you just said as to the importance of this. One, these are other things I've heard from other investors. The reason having a sell discipline is so important is because you do have an opportunity cost of if you keep the fund, the position, right? So if you buy company A and your money's invested in company A, but company B is could be a better investment at the time, and company A has gone down. Do you sell company A to buy company B? You've got to look at the opportunity cost. Your capital is limited to what you have. You don't have an unlimited supply of money. So you want to make sure that you realize every decision that you make to buy something is a decision to not own something else. And if it's gone down and you sell it, maybe to buy something else just because it's gone down. Another interesting thing I saw on this, I've never heard it called this before, but the break even fairy tale. What people will often do is they'll say, well, I'm going to wait till it breaks even and then I'm going to sell. Sometimes it doesn't break even. Sometimes you're wrong. Another, phrase that you'll hear investors use is you don't want to catch a falling knife. Sometimes you're investing, it's a falling knife. Your thesis was simply wrong and it will never break even, right? So that's a
Yeah.
real possibility. So getting out of it might be a good move.
Yeah, and I think also a term too is anchoring, where people
Yes,
anchor to a
to a
specific
price.
price, and that's
Yes.
something that is a common pitfall sometimes for investors because that can keep you from making any decisions at all where you're waiting for stock to get to a certain price and then I'll sell it, or if it gets to a certain price I will buy it, and you're so fixated on a price and that can just cause more issues when it comes to making any type of investment decision. So that's another pitfall that I think our viewers and listeners should just look more into that can just impact them.
Yeah, I completely agree with you on that. I know that uh, I have not always had that issue with selling. At least I'm sure I've had. Nothing comes to mind. I've definitely had that issue with buying. Right, you make the decision to buy a stock. I had it recently, just a few weeks ago, to buy a stock at a certain price. I finished my analysis. It was a Friday after the markets were closed, so I thought, all right, Monday I'll buy, and then it shoots up, and I want it on Friday's price. But as has famously been said, sometimes yesterday's price is not today's price, and you've got to if it's still a good deal. And I have definitely in the past anchored and thought it'll come back down, and it just doesn't, and then I buy it for a lot more than I would have before. Or yeah, I thought that's definitely a good example.
Yeah, thank you, Roshan.
Uh, a couple other thoughts on this when you're building or creating your cell discipline is it doesn't have to be just one guardrail. Like speaking to a colleague, a couple colleagues, one of them, his rule is if it's a 10% loss, he sells, no questions asked. That's just done. He will automatically sell at a 10% loss. Another colleague that said, his rule was if it has a 2% loss impact to the overall portfolio, that's what he would do in terms of selling. And once again, for both of them, those were no questions asked, not a reevaluation phase. Like Adrian said, they would automatically sell. It's difficult to do so. Something like that, I recognize that. A couple other things I've seen and heard. One is sell a little and see how you feel. So if you sell a little and you feel relief, that means you should keep selling. If you sell a little and feel regret that you didn't want to sell, maybe you shouldn't be. Um, the other thought that I think is helpful when you're dealing with this is you can always buy it back, right? Uh, so if you sold it and you decide, well, you thought your thesis was right, or you weren't happy that you sold, it's not like this is a permanent decision. You can always buy it back. And another thing, actually, it's kind of like selling a little, but what I meant by selling a little first was sell a little and see how you feel. Now I'll say sell a portion of the position, right? You don't have to. Your rule can be, if it drops 10%, I sell half, or your rule, or it can be selling the whole thing. So uh, this is going to be uh, different for everyone, customized for you as to what works for you. As Adrian said, if you build those guardrails, it's got to be a rule you can consistently abide by. So I would just encourage you to take the time to have a sell discipline, and knowing yourself, build it around you. Like that colleague who I mentioned does an auto sell at a 10% loss. Some people would be appalled by that, right? Whereas others probably think, oh, that's a great idea. So find the rule that works for you, but protect yourself and protect your downside. Going back to William O'Neill's analogy, it takes a lot more to come back than the decline itself. So you want to be very cautious.
So the only question I have for that, and maybe pushback and maybe not, like the question about the feeling part. And this could probably be like our bonus part of the episode. So, listener, viewer, if you're still listening, this could be just kind of like a free discussion here. So, the feeling part I'm having trouble with, because, again, if you're having a sell discipline, shouldn't that take all the feelings and emotions out, where you should theoretically be a robot? Because if you do feel something, that means you shouldn't be making this investment, because you should structure it in a way where, like I talked about, you're a robot. You feel nothing. If it does this, you do that, just to keep any emotion out of your decision making. Because I remember we had like a podcast a long time ago, and you and Eric were basically making fun of me. I'm just joking around here. Where you're like, Adrian, how do you feel if the market goes down? And my response was, I don't feel any type of way, because that shouldn't drive your emotions. And ultimately, you feel bad when the market goes down. You feel good when the market goes up. But I'm just saying,
Mhm.
take all emotions out of that, because you shouldn't be emotional when it comes to your investment, when you have these disciplines, these guardrails put in place to protect you from yourself, pulling yourself out of the equation.
So my response to that is, I agree that you shouldn't, but I think everyone is, to a certain degree. I
I
think
don't want
some
to feel like
people
I'm like cold here. I have no emotions.
no
Like I'm a psychopath in a way. But when it comes to like
no
investing, it's got to be something to consider.
no. I agree with you, and I think now we're not talking about numbers, datas, and facts. Now we're talking about behavioral finance, right? So if you're someone who feels nothing in terms of when you if you're someone that doesn't feel anything with the stock at all, and you can just sell, then you're probably someone who can have an auto sell at 10% rule, right? But if you're someone who feels not necessarily attached to the stock, but maybe attached to your thesis. So going back to what you had said, Adrian, I'll give you a scenario. Let's say I spent a month researching the stock. I had a thesis that I as to why I like it, why I think it's a good buy and a good deal, and nothing at all has changed with the company or the economy, and the stock has just dropped 10%, right? I still believe my thesis, but the stock has gone down. So if my rule is to auto sell at 10%, Adrian, then I agree with you. You just have to sell because that's your rule. If your rules reevaluate at 10%, you reevaluate, your thesis looks sound, and you hold. Let's say it drops another 10%, right? And um, that's not the best example. I'll give you a better one. Your thesis, so same scenario, you had a thesis, you did your research, you believe your thesis, and 6 months later the stock's down 10%, and your thesis hasn't fully changed. Maybe something's changed a little bit. Like, for example, for your example, company A is going into a specific sector you want to be a part of. And then 6 months later, the stock's down. They're still going into the sector, or at least they plan to, but they haven't actually done anything yet. There's no progress. So your thesis hasn't changed. You want to be in the sector, but or maybe your thesis has changed because they're not getting into it. Maybe they're getting into it too slow, so therefore it's not impacting the stock. So that to me is the gray area, right? Where, and once again, you don't have a sell discipline to auto sell at 10% in this case. It's to reevaluate your thesis. And now your thesis, though it's not inaccurate, is now flawed. Maybe that's the scenario where you sell a little bit and see how you feel to determine what you do. So I'm just sharing examples of what I've seen or heard from other investors for the sell discipline. And some of this stuff may be right for you, some of it not. Adrian, not to put words in your mouth, but it sounds like selling a little and see how you feel would never be a part of your list.
I mean, it goes against what I think about when it comes to investing, because I guess I want to make something more clear, because again, your experience, your history as an investor is vital. That's how you improve. That's how you learn. But here I am saying you have to take yourself out, protect yourself from yourself, because if you make any emotional decisions or you bring feeling into it, sometimes it can work out, but sometimes it can't. I mean, that's how investing really is. Somebody can be an extremely emotional investor and have great returns, and then there's can be somebody that is a complete robot when it comes to their feelings and have great returns as well. And I guess you just got to do what you think is going to be best for yourself at the end of the day.
And that's why this has to be customized, right? This whole sell discipline thing has to be customized. Um, what I had said earlier, just myself being more of a research value type investor, I really had fallen into the camp of, if it was a good deal when you bought, isn't it a better deal now? When it declines, and this is something I am definitely going to implement, is a sell discipline that will take opinion out of it and turn me into a robot at a point, right? For me right now, it's reevaluation phase and then auto sell is really how I'd look at it. The percentages I'm still toying with a little bit, but tentatively speaking, I like combining two of my colleagues' rules. The auto sell at 10%, I would take the 10% as a reevaluation. And then the colleague that does auto sell at 2% portfolio impact, I might actually do that. So I'm very heavily leaning towards that, but I have not finalized it. I think I have finalized my research on all of this. I just need to take some time to think it through a little bit further to finalize it. But I would highly encourage those of you that are listening, that are investors buying and selling, to have a sell discipline. I think you'll feel better knowing that you've got that in there. And as Adrian said, I think those guardrails will help you be a better investor. And as that study I mentioned said, it will likely help you be a better investor. That was the effectiveness of sell discipline strategies in institutional investing by Ryan Kennedy. Thank you for joining us. We hope you found this helpful and you can be a better investor after listening to us. Please like, subscribe, give us 5 stars, take control, and achieve your goals.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arete Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arete Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arete Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through Arete Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw and Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.